Welcome to our webcast titled What Senior Finance Leaders Need to Know About Investing in the UK, brought to you by CFO Publishing and by the sponsor of our webcast, Nair Company. I'm Joe Fleischer, and I will be your moderator today. What I'd like to do is tell you about our very distinguished panelists for our webcast, and what we're going to do is introduce each of them individually. So first of all, what I would like to do is tell you about Chris King, who will be our first speaker. He is the Technology Trade and Investment Officer with the UK Trade and Investment at the British Consulate General, in this case located in Boston, and he provides hands-on, fully funded, no-cost assistance to fast-growing U.S. companies and entrepreneurs that are considering setting up, expanding, consolidating, or maintaining physical operations in the UK. And his emphasis is on London's Tech City. If you've had an opportunity to visit that, it's quite incredible, which is the largest and fastest-growing tech cluster in Europe. And he certainly brings to our discussion more than 15 years of progressive economic development experience. And so he will be our first speaker. And then we will have additional perspective from Venkat Eswaran. And Venkatesh Eswaran is a Senior Vice President, Global Services with Nair Company. And he heads the Global Services operation of Nair Company and oversees. And now he manages the delivery of client services and has played a significant role in expanding Nair Company's India operations from modest beginnings. And his expertise is on India inward investment. Now, the point that he is going to bring, or the perspective that he is going to bring, is with regard to placing investment opportunities in context. And so you'll receive some very valuable perspective from Venkat as well. And then finally, we're going to hear from Stuart Buglas. He's Director of Human Capital Consulting with Nair Company, and he leads Nair Company's international HR service that handles employment law, compensation, and benefits, and as well as stock options, expatriate tax, and immigration-related issues for clients of Nair Company. So his area, again, human capital, so he'll offer a perspective on that as well. And certainly I imagine that we'll be able to address a number of questions in that area. At this stage, it is now my pleasure to turn the floor over to our very first speaker, and once again, that is Chris King, Technology Trade and Investment Officer, UK Trade and Investment, the British Consulate. Please feel free to give a warm welcome to Chris. Thank you.
Thank you very much, Joe, and thanks to everyone who's joined us today. And first off, a special thanks to our partners and our strong working colleagues in helping companies expand internationally, Nair Company, Venkat, and Stuart. It's great for us as the British Consulate to be part of this discussion. As Joe said, my name is Chris King. I'm with the British Consulate based here in Boston, Mass. I represent UK Trade Investment. I've been asked to join the webinar today to give a very brief overview and a broad view as to some of the key reasons why you should consider investing and growing your business in Europe and beyond from a base in the UK. But first off, just some context as to UK Trade Investment as a British government agency. We provide a hands-on, fully funded, no-cost assistance to companies that are considering setting up, expanding, consolidating, or maintaining physical operations in the United Kingdom. Companies that we work with, and we have literally helped thousands of companies expand and grow their business on average when working with us, get to market faster, enabling them to start selling and growing market share from day one, get to market more profitably, which is enabling them to start off their European expansion on a solid footing. And through this process, we strip out a lot of the risks associated with the expansion, which goes a long way in ensuring that their long-term success in the UK and beyond. Basically, at the British Consulate, our goals are really, and our efforts are, in everything that we do, is aligned with the client's commercial goals, which is to help them set up, manage, and grow their European business. In the UK, I'm based here in Boston, but across the U.S., we have a team of 250 staff in 9 locations across the U.S. and in London, where we focus on growing exports from the UK and attracting high-value inward investment to the UK. So no matter where you are in the U.S., there are trade and investment officers just like myself who are willing to help you get to the UK and how best to access. So very briefly, some high-level points of interest about the UK. Today, the UK continues to maintain its position as the #1 recipient of foreign direct investment in Europe, with more companies establishing their European HQ in the UK than any other country last year. and there are over 62 million customers and consumers, or potential customers in the UK, and it's an ideal gateway to the 500 million EU consumers. And very rarely today, in our experience, are we seeing companies across sectors set up in the UK just to access the UK market. In reality, companies set up in the UK to go global. From an infrastructure perspective, it's the best super fast broadband network in Europe by 2015. We're just now, from a government perspective, implementing almost $500 billion in national infrastructure. The UK is currently, as a market, the #1 in Europe for technology, financial services, R&D, and the largest market for advertising, post-production, digital media, and fashion, all key drivers for why the UK is the #1 destination. And still, the UK is one of the world's top manufacturers in Europe and in the world. And technology adoption is strong, with about 64% of the total UK mobile audience using smartphones. In the UK, as a generous allowances such as the patent box, R&D tax credits, and other incentives to create the best business-friendly environment. And today, the UK is the easiest major economy in Europe which to do business, with just 13 days to set up a company, 48 hours to register it, and by far with the fewest barriers to entrepreneurship in the world. More and more startups from around the world are looking to start up or partner in the UK from day one. So we also have a strong and flexible labor market, the 8th most competitive market country in the world, 20% corporate tax by 2015, 10% tax on patents, both of which I think my colleagues from Nair Co can expand on. So one more slide on some of the benefits and key drivers from a rich and a diverse ecosystem. We have a strong labor force, ever-increasing pool of talent to draw upon. It's the 2nd largest labor force in the EU with over 30 million people, top 4 universities, 4 of the top 10 globally, and the #1 highest graduate output in Europe, and the highest number of leading MBA courses in Europe. From an expertise perspective, more publications in science and technology and citations produced per researcher and per pound of public funding than any of the UK's major competitors. 76 Nobel Prize winners, internationally recognized expertise in a wide range of sectors, a large number of centers of excellence that you can partner with, supportive business networks and associations that we here at the Consulate can connect you to in the UK. And so what this really means is for companies looking to set up and grow their presence in the UK is that the market opportunity, ease of doing business, and rich and diverse ecosystem means market success. Lastly, it's about what it is that we do from a perspective here in the U.S. to support you. Just a few points on how we can add value. Again, this is a no-cost service that's fully funded by the UK government, and it's both comprehensive and confidential. And as a side, we're really one of the most valuable resources out there that very few people have actually heard of. So effectively what we'll do, there's a lot of points on this slide, but we really are looking to help set up when you're looking at making that business case for the UK. We can help with doing market research, making the right introductions, making the right connections. Then once you're looking at actually setting up in the UK, we work very closely with colleagues like Nair Co and making sure that you're set up in the right way in terms of a tax perspective. But we also help on trying to find that location. So if you're looking for the right location, you're looking for the right talent, you're looking for the best ways to access Europe, we can help you in that respect as well. And then we can help you continue as you set up and grow in the UK. We can actually help you expand to other European countries through the UK Trade Investment Network. But throughout the whole business life cycle of setting up, it's something that we can do for you from a base here in the UK and our colleagues throughout Europe. One last thing I'd like to say is that one of the things that we have available is a commercial path for companies that are on the line that are looking at going into the UK, who are traveling here quite often. As many of you know who've gone into London, it's quite a challenge sometimes once you get off the plane to get through the line at Heathrow. We here at the British Consulate can connect you and get you a commercial pass, which will allow you to get through the line much quicker. Instead of waiting in there for an hour or so, you can go right through the UK passport line. That's kind of the fun things that we do here to kind of make it a little bit easier for you. If you're interested in doing that, you can contact me, email me, and we'll set you up with one of those as well. So I want to thank you. It's my pleasure to turn it back over to you, Joe. Thank you.
Well, thank you very much, Chris. And now what we're going to hear is perspective from Venkat and Stuart. And at this stage, the second of our distinguished panelists who will offer perspective is Venkatesh Eswaran, Senior Vice President, Global Services with Nair Co. So please give a warm welcome to Venkat. Thank you very much.
Thank you very much, Joe, for the introduction, and thank you everyone for being here today, taking out time to listen to us. I would, and thank you, Chris, for giving that feed on UK. I would like to go through the tax benefits and incentives which the UK government offers to the industry. The main corporation tax rate is 23% for large companies, and the government has decided to have sliding rates of 21% for the next year and 20% for 2015. Small companies have exemptions. They are taxed at a concessional rate of 20% if the profits is less than 300,000 sterling pounds. There are exemptions for small companies from mandatory audit requirements as well if they fulfill certain conditions. UK subsidiaries of parent companies based in EEA states also are exempt from mandatory audits provided the parent company located in the EEA state guarantees their liability. UK has a very extensive tax treaty network, about 120 treaties signed across the world. And recently UK has signed a protocol with China, and once this protocol, which is yet to be ratified, once it becomes ratified, it will primarily make the withholding tax rate come to 5% from the current rate of 10% on intercompany dividends. Thus, you would find investments into China from the UK and conversely from China to UK very attractive because they will be having a reduced withholding tax of 5%. UK also has a favorable tax treatment for tax loss. Companies in the UK can generally carry forward losses indefinitely and carry back losses for 1 year. UK has about 24 common designated enterprise zones which offer superfast broadband and easy access to infrastructure such as rail, motorways and airports. The enterprise zone also offer enhanced capital allowances for investment in plant and machinery and other benefits such as development funding, soft landing packages with local service providers including developers and real estate professionals. Entities in the enterprise zone can claim up to 275,000 sterling pounds as business rate relief over a 5-year period, which makes it to around 55,000 on an annual basis as tax credits. Enterprise zone also suit all needs and encourages business operating in the same sector to cluster together for mutual benefit. UK has also introduced a new above-the-line credit for R&D investment in the recent budget, which is designed to make research and development relief more visible to those making those investment decisions and providing a greater cash flow support to companies. The headline rate of the ATL credit will be 10%, which has been increased from 9.1%. And the ATL scheme will operate differently. Instead of obtaining a relief within a company's tax computation, the ATL credit will be given by reducing the R&D expense category within the profit and loss account, so it will increase the pre-tax profits within the financial statements. UK has also heavily invested to create an elite network of technology and innovation centers known as catapults. Each catapult focuses on an area which the government has identified as strategically important in global terms where there is a genuine potential for the UK to gain competitive advantage. Catapults are all about sharing resources. Most companies won't consider buying machines the catapult centers can offer because as a single organization they won't be able to achieve an adequate ROI in a reasonable time. Catapults are more than just R&D and consulting hubs. They provide access to cutting-edge equipment and specialist facilities to develop and test ideas in reality for companies with limited or no means of taking the next steps to move from the drawing board to the market. UK has also around 100 science parks. Science parks have the benefit of strong links to a specific research center or university combined with access to on-site specialized business support. There is also the patent box regime in the UK, which is a big change relating to the taxation of patent income commencing in the UK from the April 2013. The income derived from patents held in the UK will be taxed at a mere 10% as against the normal corporation tax rate of 23% for large companies. Thus, it makes sense to hold your patents in the UK because the taxation rate is less than other places around the world. UK also provides employment subsidy for recruiting specified employees in Northern Ireland. Financial assistance is provided to employers for hiring specified employees in Northern Ireland. The assistance is for the first 6 months of permanent employment. The amount payable ranges from 40 sterling pounds to 75 sterling pounds per week, depending upon the age of the employee and whether the employment is part-time or full-time. There's also the Seed Enterprise Investment Scheme, which offers both income tax and capital gains tax relief to investors who subscribe for shares in qualifying companies. Income tax relief is available to individuals who subscribe for qualifying shares in the company which meet the scheme requirements, and people who have UK tax liability against which they could set the relief of. Investors need not be UK tax resident. The shares must be held for a specified period from the date of issue for the relief to be retained. Relief is available at 50% of the cost of the shares on the maximum annual investment limit. UK has decided to provide the limited extension on the capital gains holiday to continue to encourage investors to take up the new scheme. Any investors making capital gains in 2013-14 will receive a 50% capital gains relief when they reinvest those gains into seed companies in either 2013-14 or 2014-15. There is an availability of an annual investment allowance. An annual investment allowance provides for 100% tax relief of rupees 250,000 sterling pounds on qualifying plant and machinery expenditure per business group or company for 2 years for all qualifying investments in plant and machinery made on or after January 1, 2013. Now we go on to the next slide, which primarily speaks about how UK is being seen as a favorable holding company destination. UK has actually had laws now which promote it as a favorable holding company destination. There are relief on capital gains. Capital gains are generally exempt for non-resident. No tax is levied on a gain of sale of shares in a UK subsidiary by a foreign non-resident parent company. The substantial shareholding exemption broadly exempts from UK tax any capital gains on disposal made by trading companies or groups with substantial shareholdings in other trading companies or groups. However, gains on the sale of assets situated and used in trade carried on by a permanent establishment in the UK will still continue to be subject to income tax. There is an exemption on non-UK branch income and losses from UK corporation of branch income and losses from UK corporation tax. A company can elect, this election will become irrevocable. It can elect to exempt its non-UK branch income from UK corporation tax. Earlier, the UK companies which used to carry on trade in other territory were required to pay tax in the overseas territory and also pay UK corporation tax. Of course, they were entitled to a relief in the UK based on the double tax treaty, but obviously now they can make this election and then avoid the rigors of UK corporation tax and just pay taxes in the overseas territory. UK also has no withholding tax on dividends either paid out of the UK or received by the UK company subject to certain conditions. So that's a very great plus for holding company investments. And UK also provides access to tariff-free market for consumers through its membership in the European Union, and it has got free trade agreements with Iceland, Norway, Switzerland. UK is one of the larger economies of the world. It's the 6th largest by GDP and the 8th largest by purchasing power parity. UK also allows unlimited transfer of profits and dividends, loan, principal, interest, royalties and fees. Non-residents can repatriate capital together with any accrued capital gains or retained earnings at any time subject to company law or tax considerations. That's a very great plus because it doesn't have Forex control regulations, and that provides ease of business and makes it a very sweet spot for doing business. Comparison of UK with other holding company destinations in Europe. UK actually competes with Ireland, Switzerland and Netherlands as a holding company hub in Europe because traditionally Netherlands was always looked as a holding company hub, and now Ireland and Switzerland are also seen as it. While whether to set up in Ireland or Switzerland or Netherlands or the UK would depend on individual circumstances, I just want to bring to note that though it appears that Ireland has a lower corporation tax rate as compared to the UK, with Ireland having a corporation tax rate of 12.5% as regards the corporation tax rate of 23% for large companies and 20% for small companies in the UK. You've got to be careful before you actually take the decision of setting up in Ireland because Ireland taxes capital gains and it has got a withholding tax rate on dividend distribution of 20%, which UK does not. Similarly, Ireland has got only tax treaties with 62 countries, whereas UK has signed tax treaties with 120 countries. Similarly, Switzerland has signed tax treaty with 88 countries as against the 120 tax treaties signed by the UK. And Switzerland has a lower corporation tax rate of 12 to 24%, but levies a withholding tax of 35% on dividends, which UK does not. So obviously, before you just cannot take one parameter to take a decision of where you need to set up your holding company up. You've got to possibly take everything, all the parameters into consideration and then decide which one is the best suited to your circumstances. UK has been attracting, because of all these policies, has been attracting a lot of FDI into the region. According to the latest OECD report of 2013, UK has been one of the biggest beneficiaries of FDI, and it has got foreign investment inflows of 62.7 billion US dollars. UK has regained its position as the leading destination for Japanese FDI into Europe. UK has a number of strengths for having this, as earlier I mentioned about the tax relief and also which my colleague Chris mentioned about providing the ease of administration and other expertise. The most attractive sector in which investments get done is financial services, and other sectors which actually also attract FDI are telecommunications, technology, manufacturing, business to business, energy, utilities, consumer goods and retail, logistic, distribution, and pharmaceutical industries. UK happens to be a natural choice for investments from the US, and London seems to be the preferred location for investments. In UK has improved its FDI in the past year, and there is a more flexible, because of its more flexible and financial system, increased support for SMEs, which is the small and medium enterprises, effective policy framework to support businesses to set up operations, a reduced corporation tax network. UK also has more investment incentives in key industries. It promotes campaigns targeting high growth employment sectors. I would like to speak in this slide regarding the gradual shift of investments from emerging markets to the UK. Recently, there has been a trend of big companies like Aviva, BT, and Santander driving more business back to the UK and making more investments back home. India, which always seems to be the preferred destination for call center, slowly sees a shift of the work going back to the UK. Since UK companies have started going back home, and the trend is gaining momentum, though it's very slow as as of now. That may be more because of the need to better connect with customers coupled with the rising cost in India, which are driving such firms to move back home. For many, having a UK customer call center has also become a differentiator in commoditized services such as voice telephony. And the number of jobs which is expected to create by Satander is about 500, though it pales in significance to the number of jobs which the Indian IT BPO sector creates. It's still fairly significant when you actually compare in absolute terms that you create so much of jobs in the UK. Since UK seems to be outside the Eurozone, the Euro crisis in fact presents a very wonderful opportunity for the UK since the capital is on the move out of the Eurozone, with investments into the UK appearing of lower risk than in the Eurozone, and the fiscally stressed Euro states starting to invest more overseas to compensate for low demand at home. The Euro crisis actually presents a lot of opportunities and openings to UK to sell its advantages as an attractive and stable and low-risk FDI location to investors in Europe and beyond. Comparison of emerging markets with the UK in terms of corporation tax, inflation, and wage cost. Surprisingly, UK ranks better than many developing countries in terms of corporation tax, inflation, and wage cost. The corporation tax rate in the UK is 23% for large companies as compared to 30% in India and 25% in China. The annual inflation rate in the UK is 2.4% as compared to 7.2% in Russia and 6.49% in Brazil and 9.31% in India. The wage inflation in the UK is 0.6% as compared to 11% in Russia and 12% in India. So you could see that the wage inflation is actually making the cost arbitrage on the salaries slowly reducing, and a shift, slow but sure, back from the emerging markets back to the UK. Thank you for listening to me, and I'll hand over this back to Chris. Sorry, Joe.
No, that's quite all right, Venkat. So we've heard perspective specifically about the UK, and then from Chris King. We then heard Venkat's perspective as far as investment opportunities in the UK and placing these investment opportunities in context. Now we will hear from Stuart Buglass, Director of Human Capital Consulting with Nair Co, and he'll discuss the human resource implications of expanding into the UK. So at this stage, I'd like to turn the floor over to Stuart, and please give a warm welcome to him. Thank you.
Great, thanks Joe, and a warm welcome to everyone who's joined us today. So for my piece of the presentation, I'm going to take a slight diversion from some of the financial aspects of today's talk. And I want to briefly run through some of the people aspects when entering the UK. So what I'm going to start with is employment, and namely employment law. So it's natural, I think, for most organisations to want to shy away from regulations and red tape. However, my experience is such that I think having rules as an employer isn't a bad thing. It helps to set your benchmarks, and it certainly takes away uncertainty, avoids conflict with employees. But rules admittedly become bad when they change frequently, and they can require lots of administration. They can be multi-layered and very often are costly to enforce from an employment law perspective as well. So we really need to sort of fathom out where on that spectrum of good and bad does that leave the UK. So what I think is fair to say in the UK, what you see is what you get. So whilst some countries have very involved employment laws and they cover a lot of different statutes, in the UK we've got a few major statutes, so not many at all, and they apply national standards and they apply them to all employees. So you don't really have an issue with regards to different laws applying to different grades or different individuals based upon their service or their sector or their profession, really it is just one size fits all. So most of the regulations are contained in one statute, the Employment Rights Act, and it hasn't been subject to many reviews and changes year on year. So once you get familiar with that statute, it can help you awfully with regards to administering your local staff in the UK. So that one size fits all is pretty helpful, especially when you consider across Europe some of our sort of competing nations with regards to doing business in Europe, such as Spain and France, Italy, Denmark and Belgium. They all have collective agreements. Now, collective agreements are something that a lot of employers in those countries have no option as to whether they apply them or not, because they're mandatory. So if you work in a certain industrial sector, in addition to the national laws, you'll generally have collective agreements that will apply as well. And the danger of collective agreements is they add an additional tier, additional level of administration, because they'll set rules with regards to grading hierarchies. Those grading hierarchies will set minimum standards with regards to benefits and terms and salaries, etc., that you need to be familiar with when you're hiring your employees, and each employee will have, to a degree, a separate set of rules applying depending upon their grade and their profession. So you need to be mindful of that, and I mean, certainly from the UK's perspective, without collective agreements, we're relatively simple in comparison. I mean, taking that to the next level, if you haven't got collective agreements and you've only got a couple of statutes to think about, I mean, in our experience, and we cover advisory services to clients across all of Europe, what we would say is our clients generally find managing employees in the UK remotely from the US a little bit easier than in a lot of our sort of continental peers. So it's something to bear in mind. However, I mean, I fully agree that certainly from a CFO's perspective, the sort of employment law governance standpoint isn't the be-all and end-all. And what grabs your headlines, I suppose, is some of the elements that obviously will affect your bottom line, and that will be sort of annual leave allowances, overtime, and termination. So on first inspection, if you look at the headlines on that, the UK's position looks a little bit off-putting, and I think it's wise to actually scratch beneath the surface. And if you do, the position looks a lot more attractive. So if we look into this a little bit further and pick off annual leave as a starter, you'll probably see the headline figure of 28 days per annum annual leave for an employee. Now, you're right, that does sound quite excessive, but within that 28 days is the 8 public holidays in the UK, so that's incorporated in that. And what I find when I'm advising clients is, after they've spent a number of years in Europe with a number of different countries, what really makes a difference to them is just how much accumulated leave is continuing to carry over year on year for their employees. So when they terminate an employee in France or in Germany or Italy, etc., what we'll find is they'll have a massive allowance to pay out with the termination payments of accrued leave, because it's carried over every year. Now in the UK, there's no requirement to actually carry over the leave from one year to the next. So it's either a use or lose policy. So that can obviously cost savings can be attached to that. So again, it's one of those sort of see what you see is what you get. And that headline figure of 28 days, it doesn't actually increase. So if the individual gets more service years under their belt, or if they obviously increase in age, then you don't actually add anything to that allowance. It remains at 28 days per annum. Now, if you look again beyond the headline figures in a lot of European countries, you'll find that there is a moving target, because the allowance does actually increase with service or age, or potentially with the grade of the individual as well. We also don't do vacation bonuses in the UK, so you get paid your normal salary when you're on paid leave. There's no extras. And also, we don't tend to go out for statutory rights when it comes to marriage leave or bereavement leave or things like that. So there's no hidden extras with regards to sort of additional allowances. The next one, after annual leave, I think ranks pretty highly with our clients as well, is overtime. A lot of clients will actually say to us, look, when it comes to expanding into a country, we've got senior guys. These senior guys aren't the 9 to 5 practitioners that will invariably be doing more than the 40 hours per week. We really don't want to be stung with big overtime costs. And to a degree, it's a good point, because it's not just the sort of the direct costs of overtime that you've got to consider. It's the indirect costs of administration. There's a lot of forms that are obviously forwarded to payroll providers, and line managers need to sign off on those. And you'll find in some countries the administration costs of doing overtime can be quite excessive as well. So choosing a location where overtime isn't a particular issue you need to think of is certainly something that I would have on my radar. And again, if you look at the headline figure in the UK, overtime is payable. And that would tend to put you off. But what I could say is, in the UK, and it's pretty unique to the UK now in Europe, is the right for individuals to actually opt out of the working time regulations. And you might say to yourself, well, why would anyone opt out? Because if they opt out, they're not going to get their overtime, they're not going to get additional payments. But it may be through professional pride or a healthy work ethic. But what you'll find is most white-collar employees in the private sector actually embrace this. They'll sign the opt-out, and it means that you haven't really got any overtime payments to actually pay to those individuals. So it can be quite confusing to see that UK has overtime, because if you do, again, scratch beneath the surface, for the type of employees you're probably hiring, overtime's not going to be an issue, because they'll actually play the opt-out card. When compared to other countries in Europe, you'll find that that's pretty unique. So even in countries such as Germany, which prides itself on a good work ethic, there may be sort of long hours worked there, but you're going to have to pay for it, because even very senior employees will be expecting to either get payment for overtime or time off in lieu. So moving on to the next headline item, and I know you're probably thinking I'm working my way around the elephant in the room and probably sidestepping the biggest issue, which is employee termination. So in the interests of an impartial review, let's have a look at that UK termination. And I know if you're going to compare it to the US, where you've got employment at will, the UK position isn't obviously as good as that, and there are statutory protection against dismissal. However, I would plead to you to, again, just scratch beneath the surface, because the unfair dismissal rights in the UK aren't available to all. So an individual will have to work with you for 104 weeks before they actually get any right to claim unfair dismissal. So what that essentially means is, if you're going to set up in Europe and if you want to test the water, then it's a big buffer to have 2 years, whereupon if things don't work out, then essentially you could actually relinquish your workforce and relieve them without really having to think about having to go through excessive consultation processes and selection processes with regards to redundancies. Or if you have employees who aren't working out because of performance, then again, you don't have to be doing performance improvement plans, because they haven't got the right to actually claim unfair dismissal against you for that first 104 weeks. So it's worth bearing in mind. And in my mind, and in the experience I've had with all of the countries across Europe, because we advise clients all of the time, I can't think of another country that gives you that length of buffer. So you can actually test the water, and it's pretty risk-free. So on the checklist of employment nasties that we've sort of run through, the annual leave, the overtime, and the termination, I think scratching beneath the surface that the UK ranks pretty positively on an international scale. Now, as a CFO audience, I'm very mindful that obviously this bottom line and costs are important to you, and you may favour a location where you've got lower labour costs than the UK. However, having worked again closely with our clients, it's an approach that doesn't always work. And what we've found recently is where our clients have actually pursued expansion and setups in Eastern Europe, what those low-cost salaries can actually sort of provide them can be outweighed by the number of days a position lies vacant or it's potentially filled by a second-rate hire as a result of local skills shortages. And I think it's interesting to point out that the UK is currently the top destination for European migrant workers, and I think that might have something to do with the fact that there's skills shortages elsewhere, certainly in Eastern Europe, because the UK is obviously attracting that talent, and we've got a ready pool of skilled labour because of it. So having looked at the employer's position in the UK, I think we can move on and we can look at directors' duties. So hopefully you can see the next slide. So with regards to directors' duties, in the UK, directors have statutory duties to the companies they work for, and that's by virtue of the Companies Act. But they also have statutory responsibilities to third parties such as the general public, employees, etc., covering areas such as health and safety, bribery, environmental responsibilities, corporate manslaughter, etc. The difficulty in the UK, admittedly, is unlike the US, a UK company can't simply exempt or limit that liability. That liability is there. You can't exclude it. So as an alternative, companies will often provide indemnities or D&O insurance to cover the cost of those liabilities. So if we look at the indemnities, similar to the US, you'd probably have your articles of association. In there you would cover the indemnities that you're willing to provide your directors. Now, what's interesting is those indemnities can't actually extend to everything. So they can't cover liabilities where the company itself is suing a director. They can't cover fines imposed by a regulator or where the director has been criminally convicted. So essentially the indemnities are covering actions brought against the director by third parties. Now, to ensure that a director gets the benefit of those indemnities, it would be a mistake to think that just having those indemnities listed in the Articles of Association is enough. As a director, you really do need to have a service contract with those indemnities listed in there as well, because just having them in the articles might not be enough to actually rely upon them. Also a point is that the indemnities, when they're provided, they need to be disclosed each year in the director's report that accompanies the UK audited accounts, and the terms need to be available to shareholders. Now, what this means, especially for public companies, is the disclosure of the indemnities can affect shareholder confidence in the board of directors. So very often, as an alternative, companies will seek D&O insurance as a preferred route because it's less public, it can cover probably more liabilities, and this is something that we can obviously talk about now. So with regards to D&O insurance in the UK, it's a pretty healthy market. So the D&O insurances provide good value for money, they're pretty reasonable, and they provide very extensive coverage. So it's quite a crowded market. So where we advise our clients on D&O insurance, we do tend to suggest that you do look at the policy, because as a crowded market, it's not such that every policy is fit for purpose. Some are better than others. So some of the things that we suggest our clients check out, or if we're advising directors themselves, for them to check out, especially where the policies are supplied by their company, are things like, does the policy actually cover current but also past appointments? Because you probably appreciate that where a third-party claim is made against a director, there'll be a bit of a time lag, and it may be that the director isn't a current director by the time that claim hits the individual. So does the policy actually cover past appointments? Also, what we find is very often the cost and the liability will be settled in an out-of-court settlement. Does the policy actually cover that, or is it just court judgments? One other area is exclusions. You obviously want to know what the policy does exclude, and then invariably there are limits. So most policies won't cover fraud or where there's been some level of dishonesty or illegal acts. But there may be other exclusions, and you need to be mindful of what they are. Another point to make is legal costs. Are they covered? And if they are covered, can they be paid on an interim basis? Because obviously as a director, you need that cash flow to actually defend yourself. With regards to some of the other points, I mean, it's interesting to know that where regulator investigations start, who's going to actually cover the cost of an advisor to help you out as a director? Will the insurance cover those costs? And something that we often find in policies is where it's a combined policy covering a number of directors, there's usually an annual limit to the coverage. So if there's a number of claims in the early part of a year covering a couple of directors and you're not one of them, but you obviously need to claim on the policy later in the year, has that limit actually been exceeded? Because if it has, then effectively you're operating as an uninsured for the rest of that year. And also check on the time limits of raising a claim, because very often those time limits are pretty short. So it can be often difficult to actually make a claim because the time limits bar you from doing that. And finally, from a practical standpoint, just bear in mind that in the UK, you're only required to have one natural director. So your other directors can be corporate directors. And very often, bear in mind as well, a company secretary can be an external advisor. So very often companies will choose to have that to ensure that the company administration is compliant. Right, so we're moving on, and I'll move on swiftly because obviously in the interest of time, we need to get some questions done at the end of this presentation. So let's move on to data protection. So again, sticking on the people aspect of running a business. So what is data protection? So the European position is that where an organisation holds data on an individual, and it also determines what is done with it, it has the status of a data controller. Now a data controller owes the individual a duty to keep the data safe, not to disclose it, and also to ensure that the data subject, i.e. the individual, is fully notified as to what is going to happen to their data, why you're using it, and hopefully that they consent to that. So there's a lot of responsibilities there. Now those responsibilities in Europe, they're set out in an EU directive, and the EU directive has 8 core principles, and it covers things like internal security measures, encryption, passwords, etc. Also covers aspects such as the consent that we've just touched upon, and also where you use third parties, you've got to ensure through sort of contractual undertakings that the security measures continue when the data is in their hands. And also there's rules regarding transfers of data outside of the EU as well. I think what's interesting though is that directive, it's all been implemented through local legislation. So it's not as if you can actually apply one law to all of the countries you operate in. So if you're operating in a number of European countries, you need to be mindful that there's separate local laws applying to you. Each of those laws might have a need for you to register or appoint a local data privacy officer. So what I think is interesting with regards to data protection, it's not so much looking at a location where the data protection laws are more lax in one country than the other, because they won't be, because they're all the same. What you need to really look into is how can you minimize your exposure to the laws in each and every country. So to take an example, if you say set up in the UK and you're collecting data on individuals in a number of other European countries, you could have responsibilities in each of those countries to register in those countries, to have data privacy officers, so it can become incredibly cumbersome. So you need to understand how you can actually minimize that exposure. And what the data protection laws establish is where you're a data controller, have you actually got a local establishment? Now, you need to know what a local establishment is. So in the terms of the directive, a local establishment is something that is defined as the effective and real exercise of activity through stable arrangements. Now, essentially what this means is, are you using local technical and human resource to collect the data? If you are, then essentially you've got some data privacy requirements in that particular country, which means you're going to have to register, which means you're going to have a data privacy officer, and it makes it all the more cumbersome for you. So the key to data privacy in Europe, make sure if you're operating in a number of countries, try and minimize your exposure to one country by ensuring that you're a data controller who's only established in one country, and avoid having technical and human resource that collects data in other countries. So I think that concludes my presentation today on the people aspect. So what I'm going to do is I'll pass you back to Joe now, who hopefully has been collecting a few of your questions, and we can answer those as a panel.
Absolutely, absolutely. So thank you very much, Stuart and Venkat and Chris, and we do have some time in the remaining minutes to address some questions from attendees. So one question, actually, this is for you, Stuart. Attendee asks, given that you've mentioned annual leave and overtime, what should we know about paid sick leave in the UK, and what are the requirements regarding paid sick leave in the UK?
Yeah, it's a good question, actually, and it's another one of those sort of headline items where you could potentially get scared by the fact that paid sick leave is something that employees are entitled to. But again, there's some caveats to that. So the main one is, if you're going to pay an individual for a sickness absence, it's capped. So if you've got a senior guy and he's having a few days off, you're not paying him at his normal salary for those days of absence. You're paying it at a capped rate, and the capped rate's only £86 per week. It's called statutory sick pay, and that's what your obligation is, and it only kicks in after the 4th day of absence. So for short-term absences, which most employees go through, sort of days 1 to 3, you don't have to pay them anything at all. So with regards to sick pay, again, headline might put you off, but what happens in reality is a different matter. And just to point out that in the UK, people only generally take sick leave when they're actually sick. So that's the position in the UK with regards to sick leave.
Thank you, Stuart. We have time for just a few more questions, but question for Venkat. So you're talking about trend towards some companies moving from emerging areas associated with emerging markets to the UK in particular. And an attendee points out, you mentioned UK and China have recently signed a protocol providing benefits of dividend repatriation. So an attendee asks, the same attendee asks, can existing companies immediately start applying the benefits of dividend repatriation?
It's a good question. Actually, UK and China have recently signed a protocol, but it's still to be ratified. So obviously, you'll have to wait for the ratification to occur before companies can actually start claiming the benefits of dividend repatriation. But the ratification is supposed to occur very soon now.
Thank you, Venkat. And another question for you. An attendee writes, I've been under the impression that the annual investment allowance, we had talked about this earlier, limit is £25,000. Would you be able to confirm that this no longer, if that no longer applies? In other words, what is the what is the limit regarding annual investment allowance in the UK?
The annual investment allowance was £25,000 earlier, but now currently the limit has been increased to £250,000 for 2 years for all qualifying investments in plant and machinery made on or after January 1st, 2013.
Thank you, Venkat. I think we have time for
currently the limit is £250,000.
So it's £250,000 as opposed to $25,000.
Yes. Correct.
Okay, the annual investment allowance. Okay, thank you very much. Another question for you, Venkat, and then a question for Stuart, and then we will, I believe we'll be able to wrap up. But the remaining question for you, Venkat, is I understand that audit exemption is available to UK subsidiaries of EE-based parent companies. Now, would you be able to advise if similar exemptions are available for UK subsidiaries of non-EEA-based parent companies?
No, unfortunately, it is not applicable for non-EE-based parent company UK subsidiaries. It's only available if the parent is a EEA-based company and it guarantees the liabilities. So the answer is no. The audit exemption is not applicable for companies which have non-EEA-based parents.
Okay, and just for the benefit of our audience who may not be familiar with EEA, just for those who may not know that term, what does that stand for?
EEA is European Economic Area.
European Economic Area. Okay, thank you very much.
Yeah.
Then finally, thank you, Venkat. Finally, a question for Stuart. You talked about data protection. Seems like a compliance headache. Is that the case, or more positively, or what are suggestions to manage data protection? I recognize it's a webcast in itself, but what are some quick thoughts that you can offer on that?
Yeah, it is a big area, and those 8 principles cover an awful lot of ground. But I mean, what I would say is the threat to you as a business doesn't usually come from the regulators, unless you're a very large organization, possibly in social media, or you're a retail bank where you're collecting millions and millions of names and personal data on your customers. For most organizations, the threat on data privacy comes from the individuals themselves, because they're quite aware of their rights. So it's all about giving yourself a profile with them, just on the notification and on the consent side of things. So when you collect data from an individual, you need to present that you're taking control of their data, that you've obviously got their privacy rights in your best interests as well. So you provide them with that sort of sentiment or statement in a document or on your website, etc., and you get them to actively consent. And to be honest, where we've advised clients and that initial step is done, it tends to pay dividends, because the individual's comforted, they're reassured, and they're not going to question too much with regards to the internal mechanisms you've got with regards to the security measures and encryption, etc., which are all good. But what you don't want is, you don't want constant demands from individuals to justify what you are doing with their data. And if you take that initial step, you inform them, you get their consent, you tend to find that you're not going to get those inquiries.
Well, thank you very much, Stuart and Venkat and Chris. And on behalf of our very distinguished panel, Chris King, Technology Trade and Investment Officer with the UK Trade and Investment area of the British Consulate General, Venkatesh Eswaran, Senior Vice President of Global Services with Nair Company, and Stuart Buglas, Director of Human Capital Consulting with Nair Company. We all very much appreciate your joining us for our webcast, What Senior Finance Leaders Need to Know About Investing in the UK. Brought to you by CFO Publishing in partnership with the sponsor of our webcast, Nair Company. We thank you for your time, and we hope you enjoy the rest of your day.